Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for tuning in for another episode of Zen and the Art of Real Estate Investing. My guest today is Brad Johnson of Vintage Capital, also Vintage Funds. They are experienced partners in alternative investments. They structure and manage private investment opportunities designed to preserve and grow capital over time. Let's get to Brad. This is episode 259 of Zen and the Art of Real Estate Investing with my guest, Brad Johnson. Brad is the co-founder and CIO of Vintage Capital. He has 20 years of experience in both traditional and alternative asset classes. He has background experience in real estate, investment, private equity firms, and over his career has closed over $3.3 billion in commercial real estate acquisitions. Brad, welcome to the show.
Thanks, Jonathan. Thanks for having me.
Yeah, I'm excited to talk to you and talk a little alternative assets and your career. Do you remember the first time you were really interested in real estate?
Yeah, I was probably 24 or 5, and I had a startup where we were making some money, and it was in the shipping industry. We were consultants. Basically, we'd go into shippers and renegotiate their contracts with UPS and FedEx. And I was nervous that one day UPS and FedEx would just destroy our business and say, you can no longer work with these guys. And so we didn't really have any moat or anything in our business. So we started taking our profits and investing it in just single family rentals in markets that we really liked. Yeah. So Nashville, Las Vegas, Palm Springs, Austin, Texas. And so, we could go, my buddies and I could go to these cities and it'd be a good excuse to visit the nightlife.
Yeah.
Which wasn't a great thesis for real estate, but it worked.
I don't think it's that way, because when I started investing in short-term rentals so long ago, my sister and I would buy places where we wanted to go. So we just have a free vacation home. I mean, it's the luxury of having the resources, but I find it to be pretty smart investing, because then you really get to know the areas. And like you said, you have an extra reason to go.
Yeah, it was nice. And we're like, we can deduct the trip, the flight out there too. And so, it was fun. I'm glad we did it, but that definitely, I got the bug at that point, and that was the catalyst for me exiting that partnership, that business, and going off into more institutional real estate.
Yeah. Did any part of that go back to your grandfather? Because I know I read in stuff that you sent before that he owned a business, and the business didn't do great in the end, but the real estate was the thing that held on the longest.
I've seen this so often with business owners and my grandpa was certainly the case, where the actual business is a horrible business. It just kind of pays for everybody's salary, but there's no excess cash flow after they paid for all the bills, and then they paid for their real estate mortgage payments. Yeah. And so effectively it becomes like the real estate becomes a forced savings, cash account, and then it appreciates. And then when it's all said and done, there's no absolute value in the business. They can't sell it, but they have this great asset that's paid for free and clear. So that my grandpa made his entire net worth from his real estate, despite working in a plastics company for like 50 years. So that was certainly a lesson learned. But I've seen it countless times with other people in our network where it's like, hey, my business is worth $0, but my industrial real estate property is worth $7 million. So
that's just a reminder for people to buy your building, especially when you can get industrial buildings for cheap. You can get mixed use for cheap. Because I had a similar, when my dad passed away, he had a law firm for so long, and everyone's like, well, what are you going to do with the law firm? And I was a lawyer. I'm like, nothing. I don't want to do wills and estates in New York. Like, I'm good. But he always had this building right near the train station in Bedford Hills, New York. And the building was, an absolute landmark. So we ended up selling it to a restaurant. It had a restaurant and multiple offices. So he was a smart buyer. And even if your grandfather wasn't thinking, hey, I'm at least going to have this asset, which a lot of old time business owners weren't, they just thought, hey, they thought the
Oh, yeah.
business was the thing and the asset
Totally.
was the sidecar.
Yeah.
And now we know it's really the opposite.
No, it's a no-brainer for a business owner to control their real estate. You control your destiny, and then it's a great investment long-term.
Yeah, well, then I want to get your take quick on this because I've always been a big advocate of like Main Street mixed use properties, just like a couple, like 2 retail, 2 residential upstairs. But I find it gives people the opportunity to start a business without really a big risk if you own the building. You have 2 spaces, you just throw, oh, I wanted to have a bookstore like I've always wanted to. You just throw it in there. If it doesn't work, then you just, you rent it out later. And you can do that on a larger scale, but it's a really interesting opportunity with what we're talking about where people can control the asset and then give themselves an opportunity.
Yeah, I love it just from a tax planning standpoint too,
Yeah.
right? Like why, pay corporate taxes if you can buy the real estate, pay the lease, which obviously is a big expense. You're going to be able to deduct the interest on your mortgage, and then you're going to take a big depreciation charge. So it makes complete sense.
When you and your friends you started buying these single families, were you buying fixer-uppers or were you buying places that were already ready so you could go visit them? And then did you have a long-term vision on it, or was it just started?
I wish there was some thought.
You picked good markets, though, so I mean, you probably did fine.
Well, thankfully, that was our saving grace, right? Because now I know a little bit about running real estate after owning a large portfolio on a property management company. But we were doing this from 2,000 miles away in some instances, right? Where you can't drive value that way. You can't oversee a renovation, in a meaningful way. You're putting a ton of trust in subcontractors and contractors that some of them ran off with materials, right? It's like
the farther away, the more common they get a half up front and then see you later.
So we made a ton of mistakes, but thankfully we did buy in great markets. That was our saving grace. And so we did well, not amazing, but there was no vision. I mean, really, it was just like we needed some other income stream.
Yeah.
And we didn't know any better. We were 25-year-old, young guys just trying to figure it out.
Yeah, but what do you think got you all to take action? Because I think a lot of people get stuck in analysis paralysis now. They have the money and then they just get up there and they're just going to be on YouTube or TikTok, for 2 years trying to decide what to do. What at the time gave you the confidence to, hey, let's just do it. Even if we don't do great, let's do it.
I think it was actually knowing that we had this recurring income stream in our business that was generating cash flow, that we felt like, okay, well, if we miss on the budget, if we, are miss on the lease up, then we could at least support ourselves and supplement the asset with our cash flow. And so, business guys that are getting a W-2, guys and girls that have some sort of reliable income can use that as a buffer, right? If things are not going to plan. But I felt this more deeply when I was called 35 or so, when I started buying mobile home parks for the first time. Because I did more of that. Like I spent a year obsessing about it, going into the weeds, and was way more gun shy because I actually knew more. Right. So it's like when I was 25, I didn't know what I didn't know. I was dumb. Right. And whatever, we just made things happen. But then I had actually a little bit more money. I had a growing family. I had seen a ton of deals. I had seen deals in 2008 working in real estate go horribly wrong. Or the companies in San Francisco that I would see every day and talk to and hear about these horror stories. And so I just knew more. And so when I first bought my first mobile home park, I was nervous as hell. I thought like, hey, the next day after this thing closes, all the tenants are going to revolt and not pay the lot rent. And all the utilities, which I totally don't understand how all the systems fully work, they're just going to, explode and water and stuff will be everywhere. So that was harder, but it was just kind of a leap of faith going, well, I've done all that I could. It's a non-recourse loan. It's seller financing. What's the worst that can happen? We're going to lose some money here. That's the worst that can happen.
Yeah, but again, though, with what you were saying, like that has an operational business on top of it. You had all the nerves of like, hey, because there's a lot of moving parts that go with mobile homes, including the people who are going to be your operational partners, and like you said, the utilities and what's underground. But the second that you close, there's cash flow coming in every month. At least that's like a good thought. Like, hey, they should pay their rent.
Totally. Yeah, and I've never once had a tenant revolt. Every time the lot rent comes in, but the first one was scary because also that was the first time I was using really any other outside investor capital. It wasn't just my own capital, and that was scary to me. I wanted to make sure we weren't making a mistake, and thankfully we weren't. It was a great deal. But yeah, it's the getting up the courage to do it. I think is just doing a baseline level of getting up to speed on the asset class. So like you've done all you could do right before making that leap, but you'll never know for sure. Like we're all making this up as we go along. Elon's making it up as he goes along with 5 businesses. It's like
we just don't know what's around the corner. As we see right now, anything that happens in the public markets could change an investment for a day, for a week. Things could change back. So assets are the important thing. And obviously you were looking for a strong asset. But what led you to go and say, hey, mobile home parks maybe is going to be the thing that interests me? What led to that year of research?
Yeah. Well, so I think that's the best thing you could do is really just try to pick things that are like good businesses or good real estate assets that have tailwinds. And then like a lot of it's out of your hands, but that at least you can control is upfront. And for mobile home parks, it was really, I was working in real estate investment banking and I was looking at the loan tapes on a giant portfolio of loans. And I kept seeing manufactured housing in these loan pools, and they had the highest yielding debt yields.
Yeah.
And yet they had the lowest default rates. Right. So those two things should be opposite, right?
Right.
You should have, if it's higher returns, it should be higher risk. So that got my attention. And that was really the catalyst for me going off on my own. Because I was working insane hours in banking. It was a great experience, but I wanted to do something that was my own. And a lot of real estate people have this feeling too. They want to go out there, control the assets, and build a portfolio and drive returns and get the tax benefits and all that good stuff that we all know. And so that was really, when I made that leap and started buying parks and got up to 23 assets nationwide as an operator, 2,300 pads. And it was a great run. When the math started not making sense on new acquisitions in like 2020 around COVID and 21, sold that portfolio, which ended up being good timing. Was probably a little more luck than skill, but the math wasn't as compelling as when I started in 2013.
Yeah. A couple questions. When you first got, I think it's interesting that you saw the numbers on mobile home parks and realized that they were great, but did you have to fight the stereotype of mobile home parks? Because I've done a few mobile home park show and everybody always says, oh, well, there's a connotation to mobile home parks it's not real. Like anyone who operates mobile home parks knows they're basically ATMs if you do them correctly. But there's still this kind of overarching persona that everything's a trailer park. It's going to be impossible. Like all people who you don't want to manage are going to be there. It's not the case, but did you have to fight any of that? Or were you so focused on these numbers work? So let's go.
Sure. For sure. Like there are people that invest in this space that do buy those types of parks that you would not want to drive through in the middle of the night, right?
Yeah.
I've always just avoided those parks, right? I think of this more as, it's affordable housing, properties that are safe and clean. And we have an affordable housing crisis in this country. And yeah, sure. When you're, looking at a park in a remote market that's rough and it's a 10 cap, there are people in this space that think of these things as cash cows. That's the wrong way to think about this industry. Yeah. This industry, you need to come with a lot of capital and professional management to really improve these assets, because what you're offering is extreme value. The demand is not a question in this market, right? There's limitless demand for affordable housing. It's really, do you have the capital and expertise to run these things the right way is more of I think that the thing that people don't really appreciate about this asset class. And there's just a spectrum of mobile home parks, right? There are a 1-star park is, a trailer park, right?
Yeah.
Where it's not pretty, right? But that's a tiny fraction of the parks out there. And certainly out of the 50,000 that exist, you probably only are going to want to buy, 10,000 that are what I would call a 3-star or above. And those are very nice properties that will go up to like a 55 plus senior, looks like an asset that, it could go on a trophy, front page of somebody's, investment portfolio marketing materials. That, they look like the Florida, bocce ball court, pickleball, right on the water. So it's a spectrum, right? But they all are mobile home parks tech.
Yeah, and I think when you were saying there's the bad mobile home parks, yeah, it looks good with the 10 cap. I see that a lot with people who are looking to invest out of state, and they see, oh, look, it's a 2% rule, in Detroit. Nothing against Detroit. People can do really well there. But you really need to know what you're doing in city markets and understand if it's a D plus neighborhood and it's a 2%, there's a reason for that. Like, you're going to have some capex that's coming. And when you take that and multiply it by an entire mobile home park, that capex could be plumbing for everything, electrical. There's a lot of larger things that can come up because you're really responsible less for the people in their, homes, but more for the infrastructure.
Yeah, and the infrastructure is a huge part of this business, is getting that right. If you don't get it right, it's going to be a giant headache.
Yeah.
And too many syndicators got into the space. Basically, they just raised enough money to kind of close the deal with no meaningful reserves. And most of these parks were built, 50 years ago, so with existing pipes, right? They've never been upgraded.
Yeah, welcome to Clay Orangeburg pipes.
Yeah, there you go. You know the drill. Yeah. So if you aren't thinking about reinvesting into the properties and having large capital reserves, things are not going to go well. Now, thankfully, this industry didn't really get obsessed with floating rate loans.
Yeah,
and there was never, because the lot rents only go in one direction. I've never seen a lot rent go down.
Yeah.
Price. They always go up and to the right. So there wasn't as much distress in mobile home parks, but in the syndicator world as there was in multifamily, thankfully. But yeah, you can certainly get over your skis by going to a rougher market because you think that a 10 cap looks amazing and you're just going to generate all this cash flow, when in reality, you're going to be dealing with a lot of problems, right? So if you have low lot rents and the park's not in good shape, think about the kind of tenants that want to live in that property versus a property that is in great shape with good roads, is taken care of, right? Professional management. The tenant base is just going to be a lot better. So fewer headaches. So I had to really relearn that lesson. It's not just an IRR. It's not just a risk adjusted IRR. It is a brain damage adjusted IRR. Like, the amount of effort you're having to put in to get those returns varies wildly by a nice park in a great market versus something in a soft market that is in rough shape.
Yeah. I'm curious, based on your background, since when you started, you were kind of doing more remote investing and then you would go. When you started to look at mobile home parks, how many did you look at in person, if any? And was that something that played a role? Because when I'm talking to newer investors and they're just looking at, houses to invest in, I'm like, you need to get a lot of reps. But when you've been behind the scenes and you see the data and then you can match it up with photos, I'm just curious how many site visits you did to kind of understand what it looks like in person versus what the data looks like.
Yeah. I mean, I only did like maybe 4 or 5 trips to look at possible deals before we bought our first park.
Yeah.
In 14, we closed our first one. And, really, but I would land in a market and I would see every park.
Yeah,
right?
that's important.
That's the nice thing about this space is that, multifamily or office buildings, and I've worked in all these asset classes, as an employee before I started my own company. But it's really a hassle to schedule tours and actually see like all the space, right? Mobile home parks, you just show up and drive through, right? So you can see any mobile home park that you would like if it's not gated, which very few are. So that was the best part, is that I'd fly into a market and I'd literally go see, 10 to 15 parks, get a lay of the land. I would increase my database by being, oh, hey, we should reach out to this owner. Here's 5 things that we could fix with this park. And so that's kind of how I cut my teeth on just like getting a feel for how, the maintenance of these parks and the condition of them and the locations that they're in these markets. And so that was very helpful from a baseline standpoint. And now I've seen so many parks that I really can do this with just behind my desk from just an initial, just looking at Google Earth, right? You have a very clear sense of what type of park it is just looking from the aerial.
Yeah.
So but you gotta get those reps in early before you start, making offers. because when I was first starting, I would spend like 3 weeks on a model because it's my background, right? I would do like these crazy, 10 tab models in Excel and just geek out over the numbers. And then I would finally, submit my offer, because that's how it works in, institutional real estate. When you're, bidding on something that's worth 300 million, it's not a quick process.
Yeah.
But here I'd submit my offer, and the broker or the owner would be like, we took an offer 3 weeks ago, like the first one that came in. The guy that did it on the back of a napkin, and just sent it in that day, a contract, not even an LOI, right? They send contracts with their offer. So I learned real quickly, like, you got to move faster in this space, because there's not that many of them that you want to own, and they don't trade that often.
Yeah.
So you're dealing with a fixed supply, because we're not building any more of these things in any meaningful way. So you have unlimited demand, basically, and fixed supply. So that's a great place to be as an investor, but it's also a great place to be as an existing owner, so you don't want to sell it. So when you do find one, you generally have to work pretty quick.
Yeah. And I mean, when you're starting, you have no relationship. So nobody knows you as, hey, you're a closer. We know you're going to close. You're literally just like anyone. So you really have no extra cachet, which I'm sure you have now, them knowing that you've operated and closed on so many. Yeah. It's a much different thing. But it takes a while to build that up, because like you said, the guy who wrote it on the back of the napkin probably owned 14 different, with 1,000 pads. Right. Yeah. And they know, like, we know Bob, like, yeah, sure. Just put the napkin down. Like, we're good to go.
Yeah, no, it's a weapon. Your reputation in this industry is an absolute tool to go out and buy more deals and drive returns. And I often found that where it comes in a lot is when there's a deal where you came in maybe second out of 4 or 5 groups. Because a lot of brokers won't do like a broad listing. They don't want to talk to 30 yahoos who read the thesis on mobile home park and want to jump in.
Yeah.
Right. They want to talk to people that they know are going to close, which is why it's hard to break in initially.
Yeah.
Which we can talk about. But so oftentimes we'd have something where we'd submit a bid on a pocket listing, and we'd come in second or third. And because we'd done multiple deals with that broker before, if the deal fell out of contract because somebody was reaching,
even if it like smells a little funny, you're going to get the call. That's why I love being the backup. Yeah.
It's my favorite place to be. It's like that stalking horse, because generally speaking, it becomes uneconomic, right? It's like that broker knows he only has one more bite at the apple, right?
Yeah, and you have leverage. They don't, especially if it went public. I mean, went public, they're done. Yeah. Like you can't mess that up. But even in that little core structure of the 4 or 5 people who have access, they're just ranking, hey, who's a better closer? Yeah, I love it. Yeah. Backup's a great place to be, and it takes the pressure off. Hey, we lost. Cool, no problem. And then you get a call 2 weeks later. Oh, I don't know. I'm looking at some other parks. I always have leverage to get a little bit of a better deal, because now you're helping them.
Yeah, totally. And I always felt like it's winning a deal is always, you close the deal and you go to this closing dinner with the broker, and you're always like, why am I celebrating? I just paid the most money for the bad bet, right? So the stalking horse is a reputational. I put that in the alpha category of reputation. So when you're starting out, it's so hard to get to that point. Yeah. But what I found was useful is, I literally had an email list for the brokers where I would be, treating them on, like investors, prospective investors, where I'm reaching out to them once a month, like telling them, what we're focused on, where we're looking, just reminding them that, we're not just fly by night people trying to buy something off LoopNet, is that we're really committed to this. And then, you kind of create your own luck that way. Like, a deal fell out of contract, and the guy was like, oh, I know Brad said he specifically wanted this market. And so we got the phone call. So, that's kind of how you have to break in.
Yeah, I think with commercial, that consistency in relationships is so key. It's such a different thing when the more units or the higher the price points are. I always say, it's not like, you were saying before, you don't just put up a 200 pads on Zillow, or Redfin or something. Like, they don't exist in that market. They exist with the people who know them, and it's a much tighter reputational based market. But as you're saying, it's tough to break in. But I think that, like you were saying, the consistency of just calling, keeping people on the radar, eventually they're going to realize, no, these guys are serious. Like they're going to close. Like, I at least feel good taking a chance on them the first time.
Yeah, exactly. And so you almost, It actually helps you if you're willing to do something a little unusual too, right? Because, if it's pretty straight down the middle type of deal, like the broker knows they can go to one of their four guys that always close.
Yeah, yeah.
But if it's like in a market that you have a particular view on that maybe not others don't share, or it's a hairier type of profile that you're comfortable getting dirty.
Yeah, yeah.
So in our industry, that would be something where like park owned homes, right? Where it's not just the land that you're buying, you're actually buying
That's a different beast. Yeah.
It's a different beast for most operators, but you can drive big returns if you do it well. Maybe private utilities.
Yeah.
Something like that where it's a little quirky, but you're convicted on it, have conviction, then that is a way to kind of break through and get the call earlier than you would otherwise.
Hey, it's Jonathan. I hope you're enjoying this episode with Brad Johnson. And on this brief interlude, if you're interested in these large-scale investments, alternative investments, and you have rental properties, you might need some accounting help. And I know this firsthand because I'm just terrible at it. So if you need accounting help and you're a real estate investor, you can look up my friends at Hall CPA. I've had Thomas Castelli from Hall on the program before. And what does Hall do? They give high-quality services delivered by expert real estate CPAs for real estate investors. If you're interested, you can use my link at go.therealestatecpa.com/Zen. Let's get back to Brad. If you look back at all the asset classes, are mobile home parks your favorite now that you have so much experience in them? Or are there other asset classes that you've enjoyed just as much?
Mobile home parks have been my favorite just from I overly obsess about the downside and just, I want to make sure that, we don't need to get 20 IRRs. Like I just want to get teens IRRs on everything. Right. So it's my favorite from a risk adjusted standpoint. I do in another life, I think I would have enjoyed self-storage.
Yeah.
I own one self-storage asset that is super easy to run versus, mobile home parks are hairier because you're dealing with people. Yeah. Just like running a big apartment complex, you get, whatever, like 1% of the people are going to, raise some issues.
Yeah.
Right. So when you're dealing with stuff, it's just less drama. So there's certain aspects that are similar. Self-storage requires very little capital, ongoing maintenance capital.
Yeah.
Which is a great way to kind of drive long-term returns versus like office or, even industrial to an extent. You're having to redo the systems, the roof, right? There's just a lot of ongoing maintenance capital that doesn't really allow you to increase rents and drive. It just really allows you to like keep it existing.
Yeah. The second that you increase and get to the point, then you get the big CapEx. You're like, oh, we hit the seventh year. Now we have to redo all of this stuff.
It's like 5 years of cash flow just evaporated, right? With one project we didn't budget for.
Yeah.
So that drives me insane. I'm more of a cash flow investor. And in self-storage and mobile home parks, you can really model out what type of capital you're going to be spending. You're not going to be surprised by some giant multi-million-dollar capital item.
Yeah. Geographically, do you have a preference when you're looking for mobile home parks? Are there certain parts of the country that you're more interested in than others? Or are you looking at deals anywhere if the numbers present well, at least for a first look?
Certainly a preference towards red states, just given the regulatory temperature these days. It's not to say that we won't do deals in the Pacific Northwest. I do. I like them.
They have some of the best real estate for the parks out there. Yeah.
Yeah. It's just you have to be more creative about how you're going to get your mid-teens returns. You're not going to get it purely through, lot rent growth, right? You got to do it through adding pads. You got to do it through reducing expenses, bringing in your own utility providers that can drastically cut the contracts in half. So you got to just have more creative ways than just passing out a lot rent increase, which you can do in most markets if you continue to reinvest in these parks like we talked about.
Yeah.
So I really, it's not a big secret. Southeast is still very compelling from just the population growth and temperature for they're very landlord friendly in those states. And there's just a lot of parks that need a ton of capital. They need to be brought up from, mom and pop have owned them for 30 plus years.
Yeah.
They've done a decent enough job, but they never had enough money to, like, it was their only money, their only way of generating cash for their homes. So they didn't like have an extra $500,000 to like redo the roads
Right.
and the plumbing. So there's a ton of parks where the lot rents are, $400 and should be $700, where if you come in and you reinvest in the roads and upgrade the level of the park, that you can get that 700 within a few years. You don't do it like a jerk the first year, right? And surprise these people. You do it over time. So we see a lot of markets in the Southeast that we like from that standpoint. The Midwest, you got to pick your spots, right? It's because the thesis holds where if you buy any mobile home park and you put up an ad at a reasonable price, the phone will ring off the hook.
Yeah.
That's not the problem. The problem is like, do the incomes in that market support the lot rent that you need to get to cover all your expenses and mortgage and then upgrade the park, right? So I tend to like, if something is in a great market in the Midwest, like at least a very stable market with great employment base, diversified, not an energy type of market where it's only one industry. And then it's a nicer quality park, right? I don't want to go to the Midwest and buy, a 1-star, 2-star park and try to upgrade it. I want something that looks like a subdivision almost.
Yeah. That kind of that trends like hotels for me too. It's like if you're going to get into the hotel game, it's not that easy to fix up a dump, like the worst hotel on the roadside, because it still carries the same vibe. So, it'd be hard to turn that very low grade mobile home park into the luxury one because it's still in the same location.
Yeah. And even you're over improving it, right? If like you're taking a big risk going to maybe a softer market from income standpoint and then trying to upgrade it to a 4-star park. I'm not sure the incomes are there to support that type of lot rent.
Yeah.
Because then you get to $700-800 eventually a month, and it's more like a $400-500 market.
Yeah. So when you're buying, though, I mean, I know, like for some, like if I'm buying self-storage or if I was looking for mobile home parks, I'd be focused on mom and pop. But as you get bigger, who are you buying from if it's not mom and pop? We all know, like mom and pop, they're the best to buy from because of what you said. They never intended to do a big renovation. They use the bills that they get to pay for it. They're friends with the people most likely. But when that mom and pop investor sells, who's your second layer of buyer before it gets to institutional buyers?
Yeah,
sellers.
Yeah, it's still 80% mom and pop.
Wow. Okay. Yeah, that's interesting.
I'm shocked by it too. Like honestly, I thought when we started buying in 14 that we had like a 5-year window before private equity took over everything. And it's just not the case. It is in the 300 pad plus, institutional type of deals. Very hard to find that pop who's going to like sell it, through a pocket listing, who's not going to take that to Blackstone, right?
Right.
But in the, call it 50 to 150 pad, mostly you're buying from mom and pop still. Now the second category is syndicators that are just starting off, just kind of got it, over their head in terms of what it actually takes to run one of these things, right? That you can't just hire a third-party management group like you can in self-storage and in multifamily and expect them to run it perfectly, right? It's an operating business, right? Yes, you own the land and they own the homes, and it's great from that standpoint for the most part, but it's just quirky. And there's not 30 property management companies in every market that can do that. There's like maybe 2 that have a national presence, and they're better at, babysitting than they are at value add plans. Right? They're not going to be able to like completely, rehab a bunch of park owned homes. They're not going to be able to bring in a bunch of new homes to fill vacant pads, because they're doing it from 2,000 miles away themselves. And so anyways, that second tier of buyers or sellers is going to be a very small, like, syndicator or somebody who just did it with their own personal capital. And then eventually it'll start to be buying from groups that have private equity type of timelines. Whereas private equity's got to get out in 3 to 5 years, right? For the most part. So private equity started getting into the space 7 years ago and 5 years ago in a meaningful way. There's still, like we talked about, a lot of deals and a lot of consolidation left to happen, but they're starting to come up on their exit timeframes.
Yeah.
So you'll start to see like the multifamily world and the institutional space is it's just private equity guys buying and selling from each other, and we're a long way from that, but we will start to see more of those types of transactions.
Yeah, and I mean the numbers in terms of the pads kind of scale towards multifamily as well, because that 50 to 100 unit apartment building is still really owned by not necessarily a mom and pop. They're usually in the 25 or 30 and under, but they're not owned by anything bigger. It's still usually a person or a group, or like you said, what we're seeing now, very common, that syndicator who bought a good asset and has no idea how to management. And for somebody like you, that's a fantastic buy, right? Good asset, bad management, good infrastructure. That's a gold mine for you to come in. Because like you said, they're just out ahead of their skis.
Totally. Yeah. No, it's certainly something that we like to see. It helps from a diligence buying standpoint because pop generally doesn't have all of it.
Yeah. You ever been on, they're like, let me see the rent roll, and they take out like a cardboard slip and you're like, this isn't going to go well.
I've seen it all. I've seen no rent roll. I don't know. The checks come in, we cash them.
Yeah.
Or we don't take checks. We just take cash. Well, like, how am I supposed to verify?
Does the IRS know about this? I mean, this is I remember being on my friend Ryan and I were doing self-storage acquisition. We were trying to buy on our own. And the first one we went on, the guy pulled out a cardboard thing with handwriting on it. We're like, what's that? He's like, yeah, this is where I keep track of it. And we're like, all right, welcome to mom and pop. I mean, but again, that's why it was a good deal. We didn't end up winning it, but we made a compelling offer. But, mom and pops, though, I found, I want to get your take on this, especially in this space. They're very easily swayed by the shiny people that come in. They like relationships, but like when they really decide to sell, they really want the most money when they're mom and pop. So you can have a great offer, like we put a great offer on the table, and we know somebody who's going to, ask for like $250 after they do due diligence back is going to come in. And then we're like, again, second place isn't bad. Have you seen that as well?
I've actually seen, surprisingly, deals done with a handshake because they wanted to like sell to us, because a lot of times they were worried about, because they either lived in the park, right? Their dad developed it, they developed it, and like they felt like they were the mayor of that community.
Yep.
Right? They know everybody. They didn't want somebody to come. They would make me promise that I was not going to double the rent, even though I could from like an economic standpoint, right? We never did. Like I always thought that was, immoral. Like it's just insane to do that, even if you could. You get there over time, as you're improving the properties. But they wanted that handshake. I've even seen that in contracts where the seller's like, you cannot raise the lot rent more than X amount that first year. But yes, sure. There's been times where they said that, then you're within 5%, and they sold to somebody else. So it's not an absolute by any means.
But that's a great point, because mobile home parks often do carry some type of legacy, whereas a self-storage, nobody cares. It's just been people's stuff. Yeah. You know what I mean? Like even if your dad handed you down the self-storage, it's not like you're like, oh, the memories of me coming and watching people pick up their stuff. You know what I mean? But I can see like, my grandfather, he had the first pad here. It does make sense. But then, somebody comes in, pulls up with a shiny offer. It's tough sometimes because a lot of times they just say what they want to hear, like you're saying, and they will do the immoral thing, which is, oh, sure. And then they close and immediately up the rents because there's nothing really making them not.
Yeah. But I've seen some deals where it's like, it's been really fun to like, they pull out like the old drawings that dad did when they first designed it. And then, they end up sticking around. They're like, hey, can I continue to mow the grass? I don't know what I'm going to do with $10 million and with my time. Yeah. Right? Because I've been doing this for 30 years. Like, this is my life. I want to continue to help out. And you're like, okay. I've never heard about this in the institutional world, but sure. So people do get attached to these because they become kind of like family assets.
Yeah. But I mean, then again, that goes into the relationship building, not from the, broker point of view, but for when you're closing on large scale assets like this from mom and pops, you have to be really good at relationships. If you're not focused on that person or they don't trust that you're going to carry out their wishes, you're not going to win. You can't win a mom and pop like that.
Yeah, no, and I've won some deals where because they're like, okay, I feel like Brad is buying this versus some giant.
Yeah.
Sure, certainly. And it also helps on the deals that had a seller finance component to it, because they wanted to stay around and they wanted to be able to call me up because they were still involved in the asset. They still had, because they didn't want to pay the taxes or 1031 into something else.
Yeah.
They wanted to be able to take their payments over time and pay the taxes incrementally. And we're seeing that a ton right now because, lot rents are low, and yet, these values are still, they're not crazy, but they're still pretty high relative to the lot rent. And so you can only really get like 50% leverage on these things. So that's a big equity. So we're seeing a lot of structuring, a lot of pref equity, and a lot of seller financing in this space still.
Yeah, I think that people forget that just because the majority of content you see is on single family homes. I mean, there's a lot on multifamily, but seller finance is so much more important in the commercial world because there's a lot of deals that can't close without a seller finance portion. I used to own a fiveplex kind of like mini mall in Westchester, and at one point we had a gym that moved out, and that was 2 of the 5 units, so it was unsellable.
40% walks away. That's tough.
Right. Yeah. Like you can't put it on the market because who's going to lend on it with 40% gone? And we didn't want it. We wanted someone who maybe was going to use a space, but then the deli that was in the one space was like, oh, we'll buy it. So we sold it to them. And again, seller finance, sure. The same as I did with my dad's office that I told you about. We sold it to the restaurant that was underneath that we were renting. Like, sure, these are great options. But I think you have to understand that and know, what's good for the seller. Do you really want to take this hit? Because you can end up putting like barely anything down because that's better for them. They're going to get the capital gains over their payments instead of over a lump sum.
Totally. Yeah, no, I completely agree with that. Yeah. And you see it a lot in this space, partly because the sellers know the assets so well, and they're like, look, it's hard to mess these things up. I've seen the rent come in for 30 years. Like, it's not all of a sudden, going to go to zero the next day. So,
yeah. So, I mean, is it the same way that you look at acquisitions now, especially with we're recording on May 2nd. This will come out in July. Every day there's something new in the country that may change acquisitions for real estate. Does it faze you at all, or you just kind of consider that as another part of what may happen or may not? It's just not.
I try to focus on things we can control. Number one, and number two, we are set up to try to hold these things as long as possible.
Yeah.
Which, is tricky because not all capital can have an evergreen, like forever hold type of view. But vintage capital is literally structured to do the one-off deals where we don't ever have to sell. And so we do, the way we're able to do that is with partnerships, right? Because even if when I'm 80 or whatever, we still have somebody else that can run the asset and is doing the day-to-day. And so, look, if you have a 30-year view on an asset, who cares the day-to-day fluctuations in the newspaper is kind of how I look at it.
Yeah.
Whereas private equity, you got a 3-year hold, right, or 5-year hold. You have to literally try to guess what interest rates are going to be.
Yeah.
Within which is impossible. I don't think anybody can do it with any regularity.
Yeah, and that's why people got themselves in trouble. All those people who thought they were buying amazing in 2020 or 2021, and now that 5-year rate is up, and oops, they are factoring in that they were only going to go from 3 to 4.5, and now it's 7.
Totally,
big difference,
huge difference, and that's all. Like when you have a short-term hold, and it's not, and most of these assets aren't kicking off a ton of cash flow. I mean, in most of real estate, I'm saying,
yeah.
Right. So then it becomes literally your 80% of your IRR is the exit assumptions.
Yeah.
So I don't like that kind of like execution risk. I like, let's buy good businesses that generate a lot of cash fairly reliably, put conservative debt on them and hold them indefinitely. And part of that is tax driven, right? Because, a private equity firm is generally funded by an endowment, a pension fund, non-taxable, right?
Yeah.
They're 100% IRR driven. Whereas, and not even accounting for tax, but with the bonus depreciation that we get in this space and the accelerated depreciation, even if you don't bonus it, there's no taxes for a very long time. So why would I want to do that and then 3 years sell it when it took so long to buy the thing in the first place? There's not that many of them. We would much rather hold these things for the very long term, just to be able to really take advantage of those tax benefits and the cash flow.
Yeah, and one thing that as we finish up, but one thing I always say about multifamily and why I started investing in syndications myself more recently is that I am interested in multifamily and I'm interested in geographic locations, but I have zero interest in running a multifamily business myself because I don't have time. And I see this as a great corollary to mobile home park investing as well, because it's like, do you really want to run 40 pads on your own? Or can't you just take that same money, invest in a syndication with an experienced operator who all they do is a majority of mobile home parks, and then you get to learn from them? Do you think that's something that people are going to get more adjusted to? Because I'm older, but I'm still really talking to younger people saying, I think you should be looking at syndication type investments if you're accredited, if you have the money, before you start trying to flip a house or buy, a 12 unit and think that that's not going to be another job for you.
Yeah, so I've actually mentored a fair amount of people in this space, and a lot of them have actually gone on to be much larger than I have in this space, which is it's fun to see, and I've invested with them.
Yeah,
so it's fun. But what I would say is that, look, if you're younger and you just really want to do this and get in the space, yes, fine, go for it. Only if you want to buy, generally, if you want to buy multiple and build out the team. If it's more just like, hey, I think this is a way for me to make $1 million over 5 years, right? And that's going to be my big move, fine. But generally speaking, you're going to have to be all over that asset and have a full-time job, or it can't be a part-time thing for you. So yeah, it's either you're going all in as an operator, or you're investing as an LP in the space, or you're joint venturing. That's often a pretty common one to do too. I've had a lot of guys will send me deals that they don't have the capital or they don't know how to close, but they tied it up. They got under contract and they want to, that is their equity contribution is the deal, right? So you see that. And that's also a way for whether you're investing as an LP or you're joint venturing, it is a way to the next step and gain more confidence to ultimately do it on your own.
Yeah.
I've seen that plenty of times too. But I do not recommend somebody go buy a 15 pad park as a one-off investment, along with the 5 other things they're doing. I think that's a bad idea.
Yeah, I can see the JV really working if you have an operational partner, because then, that's where you're going to fail, operations right away. So if you have an operational partner who has a little more experience, or you go to someone and say, okay, I want a little more control than being an LP, which is no control. Yeah, you can get 2 or 3 people together, but you do have to piece the put those puzzle pieces together smartly, because if none of you are good in operations, you're kind of leveraging partnership that has no hope.
Yeah, somebody's got to have an engineering mindset, a systems based, dial the day to day down in that partnership. And if it's not you, then you got to be honest with yourself. If you're the acquisition finance guy, then you got to really just partner up with somebody. If you find a park in your market, then maybe you could pull it off a one-off on your own and do it part-time after a few dedicated months of turning it around. But if you're trying to do it from 2,000 miles away as your first one-off thing, no, that's a poor life.
I would think in that partnership for mobile home parks, some type of civil engineerish experience would be really helpful, because there's a lot of poor land usage that, again, like you were saying in the middle, where you can get a lot more pads out of, where that's where you can get a surprise mobile home option where you have extra land to do something else. And I think that's a kind of interesting way, but someone needs to know how to get the approval to do the lands. You just don't go start putting up more pads wherever you feel like.
No, that's tough. I've done a few of them, and it's really hard to get things approved. And it's obviously, you got to have a construction and engineering mindset to get the drawings and actually lay it all out, and retention, ponds, it's detailed.
Yeah,
for sure.
Awesome. So Brad, where's the best place for people to get in touch with you? Is it at vintage-funds.com?
That's it. Yeah. Info at vintage-funds.com if they want to directly reach out. But yeah, that's our website.
Yeah, awesome. Well, I really appreciate it. It's been a great conversation. I got some new knowledge on mobile home park acquisition, so I really appreciate you spending the time. I think it's kind of always an eye-opener for people to realize that mobile home parks can be a great asset as long as you can get away from thinking what you think they look like. Because as you were saying, they don't look like that. Some of them do, but there's a lot of great mobile home parks, and they are solving affordable housing issues that are out there.
And that's part of the reason why it's able to generate, the kind of returns relative to the risk that it has. It's just
Right.
there's a subset of people that will just never get into the space because they have that mindset of them.
Yeah. Awesome. Appreciate you spending the time. Thanks a lot.
Yeah, it was a great conversation. Thanks for having me, Jonathan.
Absolutely. That was Brad Johnson. He's the co-founder and CIO, that's Chief Investment Officer of Vintage Capital. Again, you can find them at vintage-funds.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 260 of Zen and the Art of Real Estate Investing. And it's Mark Schuler, 40 plus years as an architect, investor, and capital raiser. He's designed, engineered, entitled, and built several hundred projects and raised over $40 million for multifamily syndications with his partners in Houston, who currently manage 6,000 units, 12,000 tenants, and over $600 million active under management. We'll see you next episode with Mark.